All
Okay,
right,
perfect.
bye, Michael.
All right, next slide, please.
Oh, there we go. Did I skip a slide? Is that it?
I know that's it.
Okay.
Again, we're going to be talking about credit cards today and kind of how they work. Just as kind of a training or pre-workshop survey, just to kind of like test your knowledge and kind of see where you are now. I would recommend just looking at these 4 questions, writing down the answers. You do not have to share them with me, but at the end of the training session, the goal would be that you will be able to answer these questions if you can't already answer them. And so the first one is, you may be charged a penalty annual percentage rate if A, you have less than the minimum balance in your account, B, you pay your credit card bill late, C, you request an increase in your credit limit, D, all of the above, or E, none of the above. Question number 2 is paying only the minimum balance helps you pay off your credit card balance with minimal interest. And then number 3 is the annual fee, if any, and the APR are key terms to look for when you shop around for a credit card. And then the last is a good strategy for improving your credit history is to keep a balance on your credit card that is close to your credit limit. So again, these are just 4 general questions to kind of like help gauge where you are. What I always like to say is we're always learning different things. And so it's all about a matter of exposure. And so it doesn't necessarily mean that you feel bad if they don't know these or not. What I always say is if I were to go into like the medical industry, I know nothing about it. I depend a lot on doctors, nurses, et cetera, to tell me again how to go through and treat any medical issues I may have. And so I would say finance is kind of the same way, but the more exposed we are to it, the easier and the more we start to understand it. And so again, same thing applies for, I would say, most things. It's just all about exposure. All right, next slide. All right, so we're going to, again, just generally discuss how credit cards work and go over important terms so that you're familiar with them. So when you are ready to apply for a credit card, if you so wish, you'll be familiar with it and it won't be as daunting to go through, let's say, for example, the terms and conditions and understanding kind of what some of the key terms are. So it'll just, again, help you along the way. Next slide, please. All right, the key takeaway for this particular section is going to be, again, understanding how credit cards work so that you can, again, more effectively shop around for one that meets your needs. Next slide, please. So right now, generally, does anyone have a credit card, or does anyone kind of know just the basics about credit cards and how they work? If you want, you can just, I guess, show maybe just your wave in the chat or show a okay. All right, next slide, please.
We have a quiet audience right now.
Don't be shy. All right, so we're going to get into the nuts and bolts of, again, a credit card. So a credit card is...
Someone answered yes to you, Michael.
Oh, awesome.
Get in there.
So a credit card is a revolving line of credit. So that means that the balance on the card will go up and down as you make purchases and in turn make payments for those purchases. Credit cards can be a convenient way to buy goods and services also. Anyone that shops online can attest to that. It also gives you the option to be able to purchase items now and pay for them later. There is a limit, though, on how much you can borrow on the card at one time, and that is called your credit limit, or sometimes it's referred to as a credit line. This is the line that the creditor sets based on several factors, your ability to repay, your credit history, your income, etc. Credit cards require also that you pay at least a minimum balance every billing cycle. And so that's usually a small portion. It ranges anywhere between 1 to 5% generally of the outstanding balance on the card. And then plus any interest that's been accrued for that period is how the minimum payment generally is calculated. Next slide, please. All right, so are credit cards important? Do we need them? Some people say yes. Some people say, you know what, I'd rather pay cash for everything. I don't have any credit. I don't have any debt. But I would say they can be a very important financial tool. There are a few things, though, you want to keep in mind. Paying your credit card bill regularly by the due date actually helps build, I would say, trust. So lenders will look at that and see, or try and make a determination again if you are a credit-worthy individual. This can also be a good strategy to increase your credit scores. Banks also will receive the least minimum payment due. I'm sorry, you want to make sure that, again, your creditor receives the minimum payment due by the due date so that it doesn't hurt your credit. So making sure that, again, you pay for those on time. If the creditor does not receive at least a minimum payment due by the due date, again, it can have detrimental effects to your credit report. And so when a lender is evaluating you for either another credit card or for a home loan or a car loan, again, these are things that will count against you. And so you want to make sure that, again, if you have a credit card, that you're at a minimum making sure that you're paying that minimum balance and that you're paying it either on or before the due date. I would recommend always making sure that you pay it before the due date, especially if you're going to be mailing in your payment. Because
thank you for saying that, Michael. It's important because I'm glad you're actually talking about credit cards. A lot of times as we look at people's credit reports and we discuss credit cards, you know, some of the confusion comes with, oh, I pay on time. And like you just said, if it's not being received by the credit card company on or before that due date, it really doesn't count. It's a late, payment, to them. So.
Yeah, there's a myth that it's just so that the payment is postmarked by the due date, that the creditor will not consider that to be a late payment. But that is not true. It's all based on when the creditor actually receives your payment.
Marian, you want to share your comment?
Yes, I was making a statement about, and this is not me today, but it used to be me 100 years ago, where you got a credit card, you looked at a credit limit, you thought you were rich, and you actually looked at it like it was cash, available cash. The next thing you know, you were out of cash, out of credit limit. And that's how a lot of people get in trouble with credit cards, is you keep thinking that you look at it like a bank account. That's what I have. That's what you were provided to see if you could, if your usage, if you could do the 4 C's in credit and able to use it smartly. And I'm sure Michael's going to go over what that percentage needs to look like on your credit card. A $500 limit doesn't need to be $499, but I'm sure Michael will be touching on that.
Yes, absolutely. And you bring up a good point. Again, we're talking about credit cards and them being an important financial tool. I would say I would use them as such. And so one reason why people have credit cards is to pay for emergency expenses if they're short on cash. But again, that is with the expectation that they'll be able to pay it back eventually. So not carrying a large balance for a extended period of time. And so it's just a matter of how you use your credit cards. And we're going to get into that a little bit later, how to effectively manage your card to make sure that, again, when you're being evaluated by a creditor, it shows that, again, you are a credit-worthy borrower, that you, if they extend you credit, that, again, you'll be able to pay that credit back on time and as agreed. I'm a banker, and so I guess maybe our viewpoints may be a little bit different sometimes. And so for us, it's kind of like second nature. We deal with this stuff all the time. But I would say it would be the same as if I were a complete stranger. Let's say I didn't know Annie or Marianne, and I asked Annie and Marianne, hey, can I borrow $500 for a year? I'll pay you back at the end of the year in full to make sure that, again, it's all done. But for now, can you lend me $500? And so they would want to know certain things about me to make sure that, again, that I'd be able to pay that money back as agreed, and probably with interest. And so banks are kind of the same way. So they want to evaluate and just make sure, again, that you have the capacity to be able to, again, pay back any debts that you incur. Also with credit cards, it gives you the right to be able to go through and dispute any erroneous charges that may appear on your bill. So if you're making purchases online, it's not as if, okay, you're given the card, and then if there's anything that happens as far as fraudulent charges, that you would be responsible for it. Outlining your terms and agreements, it will tell you, again, that you're not responsible for any unauthorized charges. And so there's an investigation process that will happen. And then after the investigation, they will go through and yield a response, let you know, again, based on their information from their investigation, if the charges are considered to be unauthorized or authorized. And we will touch a little bit on that also. And then you also, another perk, I guess, about using your credit card to pay for goods and services.
Can I stop you real quick?
Sure.
I'm sorry, I was talking and I was muted. We have a question in the chat. You want me to read that off to you, or can you see that?
Let's see. If you have a large balance with okay, I'll just read it just for everyone. So if you have a large balance with a high interest rate, do you recommend getting a personal loan with a low interest rate to pay off the balance of the credit card, or is this not recommended? And I would say it depends on your personal situation. And so if you have the cash flow to pay it off without having to get a credit card, it may be to your advantage just to pay off that credit card. If you don't have the cash available, then that would be, if it were me, that would be my choice, would be to go to a lender that offers a signature type loan. Generally, those are unsecured. Generally, you also have to have decent credit in order to apply, I guess, qualify for those, because again, most of those are going to be unsecured. And then generally what will happen is that they would extend you a loan, and when they extend the loan to you, it's going to be classified as a installment type loan versus a revolving. So like your credit cards, again, the balances go up and down, but this type of loan is going to be considered to be more stable. You're going to be paying the same payment every single month for a set term, and then once that's paid off, you're pretty much done. The thing I see the most with people that get personal loans to pay off cards, and this is professionally and then also personally, is that they'll get a loan. Let's say I've charged up $2,000 and I don't want to pay 18.99% for an extended period of time because I can't afford to pay the car off in full. It may take me a year, it may take me a year and a half. And so what I've decided to do is just get a personal loan at a much lower interest rate to pay that card off. And so I'll go through and I'll do that. And let's say I qualify, I get the card. But what I see a lot is that people will take those same cards and charge them back up. And so an emergency comes up, or they see that, oh, my balance is down, I have no balance, and so I'm just going to use it temporarily. There's something that I want, I'll pay it off. But then they never end up paying off that balance. And now they have two. So now they not only have the credit card, but now they also have the personal loan that they're trying to juggle payments for. And so if you're going to do that, you may want to consider, again, working out or figuring out a way in which you could put the cards maybe in a safe deposit box so that it's harder to access versus just having it on you. So just some method that would make it a little bit more difficult for you to be able to access those cards if that's the route that you're going to go. There was another question. Once a credit card goes to a third-party collections company, do you suggest paying the original creditor or the collections company? That also will depend. And so generally what will happen is that the original creditor is going to sell the debt to, or a lot of times they will sell the debt to another party. If they're only having someone collect the debt on their behalf, though, let's say they haven't sold it, the original creditor still has shows as charged off on their books, and now they're working with a third-party collections company to go through and try and collect that debt. If you can pay the original creditor, you can go through the original creditor. In a lot of cases, though, they're going to refer you to the collections company. In any case, what you want to do is get something in writing from whoever you pay. And so if it's the third-party company, for them to acknowledge the debt that you're paying with the original creditor's name, the account number, the amount that was outstanding. Generally, I would also recommend whatever address was on file at the time to include that in the notification of the payment that you're making, so that, again, you have support. So should this debt show up on your credit report and you need to dispute it, you can then go to a you can submit that documentation to the credit reporting bureaus. And so, for example, if it's in collections, it's still going to show as, again, it being late or charged off. But as far as like an outstanding balance, if the third-party collections company never submits the file to the credit reporting bureau saying that you paid it off, then you could then take that documentation and submit it directly through a dispute with any of the 3 credit reporting agencies and have that item removed, or not removed, but have it show on your credit report that the amount's been paid in full.
So Michael, so it's not necessarily better or worse to pay the original creditor directly versus the third party?
In my opinion, no. I would say the main thing is just making sure that you get documentation of the amount that you're paying and that the debt has been paid in full.
All right, good info. Thank you.
Does pay for deletion still exist? If you're referring to, there was a question, does pay for deletion still exist? I'm just a little bit unclear. Are you referring to, like, let's say, for example, someone to fix or repair your credit report? Because if so, generally what companies were doing is that they would go through and do the same thing that you could do. They go through to the credit reporting agencies. No, pay a previous debt in full, but get it deleted. Gotcha. Again, okay, her question, or the person's question was, does pay for deletion still exist? And she says, like, for example, paying a debt in full to have it removed, or I guess purged from your report. I would say that would be very rare that would happen. And if so, you will want to make sure, again, that you get something in writing. But I have never seen where, again, we've had a charged off a debt, whether it be on a deposit side or a loan side, and we actually submitted information to the credit reporting bureau saying that, again, we want to have that information purged. Generally, the only time information would be purged from a report would be if we submitted something erroneous to the credit reporting bureaus. But generally, it would still be, it was still showing your report. It would just, again, show us paid in full. And anyone that's marketing any type of, again, pay for deletion, I would be very wary. To be honest, well, to be honest with you, I would say eventually they may. Well, I'll just move on from there. But I would just say again, if anything that anything related to that, just make sure you get something in writing.
So is it fair to say it's few and far between that a company, like say in the negotiations to pay off a debt, the consumer would make the request of, I'll pay, this in full if this is removed, blah, 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 and they get that in writing. So that those type of situations don't happen often, or not much.
Like I say, I've been in the industry for over 20 years, and I've never seen it happen. I've never worked for a creditor who negotiated and said, I'll remove it from your report.
Okay.
Because again, we are bound by rules also as far as reporting information to credit bureaus. So as a furnisher of information, there's a set of guidelines that we have to follow also. And so again, like I say, the only time that any information that we're submitting generally is going to be removed is going to be if we made an error in reporting the information to the bureaus. But outside of that, I don't see it.
That's good to know. Thank you for talking through that.
Sure. All right, next slide, please. All right. And so there are different types of cards, or there's other cards that are give the impression that they're credit cards, but not really. So for example, charge cards. Charge cards are not considered credit cards. Those are cards where, again, you have to pay the balance in full every single month. And so those don't involve, again, your revolving, where the limit, the amount that you have outstanding is going to go up or down. Also, prepaid cards, also sometimes called stored value cards, are also not considered credit cards. And then, of course, debit cards. Those are also not credit cards, even though they are branded sometimes with the MasterCard or Visa logo on them. But again, they're not credit cards. By having that brand just allows the merchant to be able to submit the transaction using the MasterCard or Visa cards network. But again, it's not a credit card. So generally what happens with the debit card is, again, there's going to be a request. So once you swipe or insert your cards, a request is going to go to through the network and say, okay, almost back to your financial institution, say, do you have the money available in your account to be able to make the purchase or cash withdrawal? If you get an approval, then you can. If you don't, then it's going to decline that purchase. So again, the money is withdrawn directly from your checking or savings account. All right, next slide, please. All right, there's disclosures that's also required to be given to consumers as it relates to credit cards. And so there's disclosures that require a creditor to disclose any type of rates, fees, restrictions, et cetera, that relates to a credit card. It's called a Truth in Lending Disclosure, or TILA. It's similar to, if you're getting like a home mortgage loan, you get disclosures before you close the loan, letting you know all of the terms and conditions of the credit, what your interest rate is going to be, what your late fees are, if there are any, what date your payment is going to be due, how much interest you're going to pay, what the rate is, what the APR is, et cetera. And so the same thing applies for credit cards. So you are going to be given a written disclosure. If you're not, then that's something that you would want to report to that creditor's regulator, because they should be disclosing to you all information related to that card and its terms and conditions. The Truth in Lending Disclosure, the whole purpose of it is to allow you as a consumer to be able to shop and get the best rate. And so if I were to apply for, or potentially I was thinking about applying, let's say, for example, a card through Capital One and Chase Bank, I could go through the process and request a truth in lending disclosure, which will give me the terms and conditions of each. The format is exactly the same. And then I should be able to take those two disclosures and compare and see which one is going to yield me the best rates or fees, which one's going to be best for me. And so Congress, when they passed the Truth in Lending Act, that was one of the main purposes, is to be able to make sure that, again, consumers could shop for credit using disclosure that's substantially the same. And so we'll talk a little bit about like APR, annual percentage rate. So a lot of times you'll see interest rate, and then you'll see APR. APR is going to be, again, the cost of credit expressed annually. And so it's going to consider not only the interest, but it's also going to consider any fees or other things that are associated with the type of credit that you're applying for. And so, for example, if I'm applying for a credit card and I'm given I'm thinking about it and I want to get a truth in lending disclosure, the APR that's included on that disclosure should consider, let's say, for example, any annual fee that may be included as a condition of getting the card. And so when I look at my APR for the credit cards, one may have a fee, one may not have a fee. But the APR, again, is going to factor that information in. And so when I'm looking, I can just look at that instead of looking to say, okay, well, this one has an interest rate of 13% and then a $595 annual fee. This card here has an interest rate of 14.99%, but it doesn't have an annual fee. Which one is going to work best for me? And so the APR takes all of that thought process out of it and just says, look at the APR. Whichever one's yielding the lowest APR is the one that is going to be the cheapest credit when you express the interest that you're paying and fees, et cetera, over the course of a year. The same thing would apply for a home loan or for a car loan. If you're shopping, you always want to look at the APR. The interest rate is not the important factor there. Again, always APR. There's also a penalty APR that will be assessed on credit cards if you don't pay your bill on time. And so this is something that you really want to make sure that you pay attention to. And if you are applying for a credit card, if you receive one or have one, that you look through your terms and conditions and see what the penalty APR is for your card. It should also be reflected on your monthly statement. Also note that the APR will be different based on the different types of transactions that you may use your card for. And so with a credit card, you may use it for general purchases, but you also may use the card to transfer balances, let's say, from another card. And so you may take advantage of a teaser introductory rate where they're offering maybe 0% for 12 months. And you know that you can go through and pay the card off within that time frame. And so you decide to transfer the balance from a higher rate card over to the one with the 0% interest rate. And so generally with balance transfers, when you see, again, higher APRs, it's going to be after that introductory period. And so that means that you're carrying the balance for longer than the period that, again, may have been included, maybe, for example, in a introductory rate. And then in some cases, it may not be an introductory rate. You just may want to consolidate all your cards into one to make it easier for you to manage. And the one you're consolidating to may just have a lower interest rate. And so you're just going to transfer your balance from one card to another. But again, just note that that balance transfer APR may be different from the APR for the purchases that you've been making using your card. And then of course, the highest is going to be your cash advance APR. And so if you were to take your credit card and go to an ATM and withdraw cash, if you've been issued a PIN, generally you're going to pay a pretty high APR on those cash withdrawals. Also, if you set your card up through, let's say, maybe a peer-to-peer type service, maybe Zelle or Venmo or something like that, and they're going to allow you to do transfers using your card, let's say from one individual to another. Those, I would say 99.9% of the time also fall within that cash advance realm, and you're going to be charged a higher APR for those types of transactions. So something I would, again, make sure that I'm looking out for. With your interest rates, again, those can be variable or fixed. With a fixed interest rate, that means it just stays the same throughout the term of the card, unless the creditor decides they want to make a change, in which case they would give you like a 45-day advance notice that they're going to change your rate. Whereas with a variable rate card, the interest rate is going to vary, and it's usually tied to some type of an index like the Wall Street Journal prime rate. So you guys have probably heard in the news that the Fed is going or considering raising the interest rate again. So they raised it here recently in March by 0.25%. or 25 basis points, and they're looking to raise it again in May by another 0.50% or 50 basis points. So if you think about it, so that's like 0.75%. So if I had a variable rate card, if the Fed raises the rates and it's tied to that index, let's say Wall Street Journal Prime, and they change the rate for WSJ or Wall Street Journal Prime, then that's going to affect my card and is going to raise my interest rate for that card. And so something that you want to consider. Next slide, please. So again, we kind of touched a little bit on teaser rates. Again, those are generally a way for a creditor to try and get you to sign up or apply for credit. Again, they make it very attractive and start you out with a low rate generally. And then after a 6-month time frame, they'll increase your rate. And so by law, any type of teaser rates have to be in effect for at least 6 months. And so generally, if you're looking at most of the ads out there, you'll see again 6 months, 0% APR, maybe 1.9% APR for 6 months. And then after that is the part that you really want to make sure that you're paying attention to, is what happens after that period ends. And so if you haven't paid off the balance, then generally what's going to happen is, well, what will happen is that the rate is going to increase. And it could increase, like an example here, to 15.49% or 25.49% that you're now paying on this credit card that started out with a 0% interest rate. Next slide, please. All right, so the slide's a little bit small, but again, I just wanted to, I'll just recap really kind of what we've learned as far as terms. And so again, late fees, again, these are fees that are charged for not making your payment on time. So no matter what, I would say try to make sure that you make your payment on time. If for whatever reason you're going to be late paying your card, I know things happen, contact your creditor in advance. Or if you can't make the payment the same day, let's say, I don't know, your internet on you waited till after to make the payment. And generally most creditors will say if you make the payment before, I don't know, 11:59 p.m. Pacific time, that again, it won't be considered late. And so you're pushing up to that time and you can't log in or you're having issues, if their number is still available, if they have a customer service rep that can talk to you at that point in time, I definitely would reach out. If not, then I would contact them at the next earliest convenience and see, again, if maybe they can waive the late charge related to, again, you paying your payment late.
Michael,
or if you can't afford, I'm sorry, yes.
That's okay. I'm sorry. Can you talk a little bit to the fact of when you do contact the credit card companies and you make the request, to pay your credit card payment late, do they kind of uphold not informing the credit card, not credit card, the credit reporting company that you're late so you don't hit that ding? We have folks that are working on their credit, and like you said, things happen. Is that truly an option, or would they continue to just report as normal?
I would say it depends on the creditor and how late you are in making your, and how late the payment is. So I would say just generally, I would say most probably won't report if you make the payment. I'll give you the lower tier. I would say, let's say within 5 days, they would still charge you the late fee, but it wouldn't be reported to the credit bureau. Some go as far as 30 days. So if you were late, but you pay the fee within that 30-day time frame, and then you bring it current, then they may not report. So that's something that, again, if you have been late, you definitely want to contact your credit card company and see exactly what their policy is. And generally, they're going to go by a set of guidelines also, as far as if they are able to not report, or if they are required to report. I'm going to say in most cases, again, if you're outside of their tolerances, let's say, for example, the 5 days or the 30 days, whatever it may be, they're going to report. I would highly caution if you are going to depend on one of the representatives telling you that they're not going to report. If they're not, generally, again, it's based on some policy. And so you can ask for a copy of the policy, or what exactly their policy is for reporting to credit bureaus for late payments. Sometimes it will be outlined in your terms and conditions. But again, you want to go according to, again, what it is that is, I would say, generally listed in writing. But even myself, I would not rely on, again, the word of someone that's on the other end of the line telling me that, again, it's okay, don't worry about it. Now, they may be able to reverse the fee, and they can do that right away. But as far as submitting those, that payment history to the credit bureaus, it's all batch files. And so they would have to have access to be able to go through and modify or override those changes for that batch file that's going out for that creditor. And so I'm not going to say it can't happen, but usually it's set up based on some type of algorithm that will say, okay, this is the date the payment was received. Are we going to report or not report?
Right. That makes a lot of sense. Thank you for breaking that down. And that goes to Marianne's comment about getting writing. I think I'm assuming she's talking about talking with the customer service rep when they say it's okay to pay late.
Yes. Yeah, if they can send you an email, or I'll move on. Annual fees. Again, this is a fee that's charged usually yearly in order for you to be able to use the card. And so, like, for example, if you're shopping for a card, that's one thing, again, you want to make sure that you consider, because this fee is going to be incurred on an annual basis. And depending on the card and kind of what services are being offered, it may be high, may be low. I have a United card because I do a lot of travel. And even though I have good credit, I still pay that annual fee. Every now and again, you may be able to work with them to waive it. Oh, I've been a long-term customer, I've been loyal, and they may waive it once, but again, it's not something that I expect. So it's something that I know going into, actually I knew when I applied for the card what the fee was, and I was prepared to pay the fee based on, again, the rewards that I would be receiving based on the level of travel that I was doing. Cash advance fees, we kind of went over that. So again, not only are you going to be charged a high interest rate, a lot of times you are charged fees also for obtaining those cash advances. If you do travel, this is less common now than it was in the past, but there's sometimes foreign transaction fees for converting the currency. So if I were in Rome if I'm going to convert the euro to the dollar, usually there's a fee that's associated with that. And so again, that would be charged on my next billing cycle for, again, that transaction. So if I went to Starbucks in Italy, whenever they, again, do the conversion for that charge, again, they most likely going to charge me would have most likely charged me a fee. Like I said, again, I think now it's becoming less and less common, probably based on competition. We went over balance transfer fees, so I'll skip that one. Also, credit limit increase fees.
Michael, there's
Sure.
a question in chat regarding, it looks like a travel credit card, United versus American Express, which is better for traveling?
So I'm gonna go back to it depends. And so I used to only have United. I recently got American Express because I know they have well, I got United because I wanted to be able to go to their lounge. And so when I'm traveling for work, it's convenient for me. And so I can go in the lounge, it's much quieter, there's food and all sorts of stuff I can take advantage of. So that's why I got the card. American Express has their, what is it, Centennium room, but they're not available at all airports. And so when I was evaluating, initially that's what I was looking at. So United was in most of the places I was traveling. And I was also, again, getting mileage, et cetera. And so that's why I end up going with United. So really, I would say it just depends on, again, the perks and kind of what you're expecting. So for example, with American Express, there's advantages to that one too. So even though they're not in as many places, I can get a credit back on my card if I want to sign up for Clear to expedite my travel through the airport. And so instead of having to wait in those long lines, they'll pay or they'll reimburse me for the cost of signing up for Clear. And so again, it just depends on the rewards and how the card's going to work for me. So everyone's situation, I would say, is different. If you don't travel a lot, then yeah, it's just looking at the card and kind of what the perks are to it. So I hope that answered. Let's see, over limit fees. You also want to make sure that you are not going over the limit. Generally, you will have to opt in though if you are most credit card companies don't allow this anymore. But again, if they're going to allow you to go over the stated credit line, then they have to allow you to opt into that. And then once you opt into it, then they can charge you a fee for going over the credit limit. But again, either they don't offer it or they don't charge fees. I think I skipped over credit limit increases. Generally, this is done on an annual basis. If you want to have your credit limit increase more frequently, you can submit through the creditor for them to go through and do a review and see again if you qualify for a increase in your credit line. Generally, yeah, I guess it just depends on the credit card company. It'll be listed though in that truth in lending disclosure I talked about earlier, or your TILA. If there is a fee associated with requesting a credit limit increase. Generally, if they'll do surveys though, I would say at least once a year And then they take that information and they do their own in-house analysis to make a determination if you may qualify for a credit limit increase or not. And it varies from card company to card company and the type of card that you may be using. Okay, next slide, please. So we kind of went over, again, some of the rewards of having a credit card. So again, rebates, points, airline miles. I mean, if you like to fly Southwest, that's another card that you could utilize. I am going to...
Marianne's mentioning if you touched on recommended percentage usage versus credit limit. Is that coming up?
It is coming up. Am I, is it going to be 7:30 or 8 o'clock?
Yeah, it's 7:23.
Okay. All right. So for credit utilization, I'm going to move ahead a few slides. Generally, what you want to make sure is that you don't utilize more than 20 to 30% of your credit limit. And the reason why is because the higher utilization, it's an indicator for lenders that, again, you may be having a hard time with cash flow. And so you may not be able to, your cash flow may be limited, so you can't afford to pay off your credit card or and it's going to have an adverse effect on your credit score also. It's going to drop it. So the higher your credit utilization is, that is, again, going to have a direct impact on your credit score. So for example, if we're looking at secured versus unsecured credit cards, so again, a secured credit card is going to be one that is secured by some type of collateral. And so you may have a certificate of deposit, or you may have, they may allow you to deposit money into a savings account, and they're going to put a hold on those funds. And as a result, give you a credit card. You may have good credit and want a secure credit card. You may have not so perfect credit and want to start building or rebuilding your credit. And so that may be another reason for getting a secure credit card. But in any case, if you don't pay back the amount that's outstanding on the card, then they would just offset it against, again, your deposit account or your certificate of deposit. What I was going to say is, with your secured card versus unsecured, generally your limits are higher with a unsecured versus secured. And so when we're talking about credit utilization, especially if you're looking to build your credit, you want to make sure that, again, you're paying very, very, actually with both, you want to make sure you're paying very, very close attention to your credit utilization, and not just for that one particular card, but across all cards that you have. And so we'll start with one. So if you have a secure credit card and you have a credit line of $500, and you're charging $400 every single month on the card, then that's going to give you a high credit utilization. Again, it's going to be an indicator to a creditor that, again, you may be having cash flow issues, meaning that you may not be able to go through and pay your debt. And so this is going to have a direct impact, again, on your credit score. Conversely, if you have that $500 credit limit and you only charge, I don't know, let's say $50, in this case, your utilization is going to be lower, which, again, is not going to have a negative impact on your credit score. And then it also shows the lender that, again, you're, again, not relying solely on a credit card to maybe support yourself or pay bills or whatever it may be. And so it's important to make sure that you're monitoring your credit utilization. Also, with multiple cards, you want to make sure that, because a creditor will also consider the total outstanding credit that you have available compared to your utilization. and look at that also as a measure of, again, can you afford to pay back the debts that you incur? There's also a myth, or a lot of people say, well, I'm building my credit, and so I know I need to charge something. And so I'll go through and I'll charge something every single month, and then I'll hold the balance maybe for 2 or 3 months, and then I'll pay it off. You don't have to do that. So again, if you're looking to build credit, you do not have to hold or not pay your balance in full in order to be able to build your credit. And so if you were, let's say, utilizing a secured credit card because you want to, again, build credit, you may be, I don't know, you may have good credit and you may be looking to build it up to excellent, I don't know, whatever your circumstance is. But again, let's say, for example, you're looking to do that. And so you have either a secured credit card or an unsecured credit card. And so if you're going to use the card, I would use it. And if you can afford to pay the balance off before the due date to avoid interest, then I would do so, what's called a grace period. And so don't think that you have to carry a balance in order to show that, again, you're utilizing the card. That also works, I would say, for your credit utilization. You also want to make sure that, again, you may say, well, I'm going to charge $450 of my $500 limit, but I paid it off before I paid it in full, so no problem. Actually not. It's still going to have a negative impact on your credit score.
Oh, that's so important. Say that again, Michael.
Sure. So if you are, again, going to charge up a credit card and you, excuse me, think that you don't have to, or I'm sorry, I lost my train of thought there. You want to make sure that, again, if you have a credit card, and let's say, for example, you have a $500 credit line, if you charge up $400 worth of items or purchases, if you think that by paying off the $400 at the end of the month, and it's not going to affect your credit utilization, that is a myth. It will have an impact on you. So again, whatever you charge during your billing cycle is going to have an effect on your credit score.
Yeah, that is so important. It's definitely a great responsibility that comes with having and using a credit card. I think that's
Absolutely
what you're driving home in your presentation this evening.
And as Marianne said, again, on your billing statement, there's a lot of important information. I know we're pushing up against time, so I would say I will provide a copy of the presentation, but you want to make sure that you get really, really familiar with your credit card statement and what's on there. So looking at your billing cycle, when does your billing cycle begin? When does your billing cycle end? And I believe that is on, just really briefly.
I can scroll if you just tell me when to stop. I'll just keep scrolling.
Okay, it should be around slide 29. Ah, there we are. I'm not sure, hopefully you guys can see it, but again, at the top, it lists the account number. It lists, again, the date that the billing statements start, which in this case is February 21st, 2020, and it ends March 22nd, 2020. It lists what the previous balance was. And so the balance for your prior period, it'll list any payments and credits that you've made, any type of purchases and adjustments, any balance transfers, cash advances. Again, all that information is going to be itemized on your statement. Here, we're looking at a summary, but again, you'll see all of those charges later on, line item by line item. And what I would recommend is you keep track of what you're spending and make sure that every receipt that you have matches up with what's on your statement. If there is a charge that's on your statement that you did not make, then contact your creditor right away. Like I mentioned earlier, any unauthorized charges you should not be responsible for, just so you report it timely to your creditor. And generally timely means within 60 days of your statement being, within 60 days of you receiving your statement. If so, then generally you're not going to be responsible for any unauthorized charges. If you go outside of that state, that 60 days is when you start to incur liability for unauthorized charges. The same would apply for like a bank account. So again, make sure that you're looking at your statement and again, disputing anything that, any charges that you did not make.
There's a question in the chat, Michael, from Clarice. Would you say using a credit card is safer than a debit card since it's not linked directly to a bank account?
It's another good question. And I would go back to, again, it depends on your situation. I think both are good. Both have consumer protections that are very similar. And so any unauthorized charges, again, you won't be responsible for. The only, I'll say the biggest difference would be maybe cash flow. And so, for example, if someone used your debit card, it's going to take money from your checking account. And so generally a bank has 10 days to go through and resolve the issue. And if they can't resolve it within 10 business days, then they'll have to go through and give you what's called provisional credit. And so they'll credit your account for whatever the disputed charges are while they're still doing their investigation. But again, you're still out that money for 10 days. Whereas with a credit card, you technically wouldn't be out the money for the 10 days because the you would go through and file a written dispute to your credit card company saying that, again, the charges were not made by you. And again, a key to that is written. On your statement, there will be an address of where you can send any disputed items. So not just calling and saying, hey, I didn't make those charges, but making sure that you submit something written so that, again, you can be, in most cases, so that the interest that's accruing on those charges, you won't be responsible for, pretty much. And so, again, but it's only generally if you are providing that, again, to them in a written format. The same thing would apply for a debit card. And so with a debit card, if you're submitting a dispute to your bank, you want to make sure that that's written too. Because again, if it's going to take them more than 10 days, you want to make sure that, again, that they provisionally credit your account while they're still doing their investigation. So that's what I would say as far as maybe one being safer than the other would just be, again, availability of funds. Where I will also say your credit card, though, also provides other protections. And so generally, if you don't receive goods and services, a lot of your credit cards will have a consumer liability protection in there to make you whole. And then the credit card company will work with the merchant to clear that up. If the items that you receive are defective or whatever it may be. So if you're making purchases, it could be to your benefit to use a credit card. Sometimes it'll also extend a warranty period on an item. So you may be purchasing a refrigerator, and if you use your credit card, it may extend your warranty by an additional year for that item. It just depends on, again, what perks your credit card is providing. Whereas most debit cards are not going to provide that type of, actually, they won't provide that type of warranty. It would be through a credit card company. Let's see. There's also information on here, also very important about, again, who you should contact if you're having issues with, again, paying your bill or just credit in general, credit counseling. And so this is mandated by federal law to have a credit counseling agency listed on here, or a number that you can call to seek information related to, again, credit counseling. Like here it mentioned, again, that penalty APR. And so we talked about that a little bit earlier. See, it's 28.99%. So that's pretty high. And so you want to make sure that, again, you're paying your payments on time. It'll tell you what the payment date is. So here the payment date is 4/21/2020. The minimum amount that's due is $20, but you want to make sure that if you can afford to pay more than the minimum amount due, that you're actually making payments beyond that. Otherwise, it's going to take you longer to pay off the card, and you're going to incur a lot of interest as a result of that. Credit card companies are required to give you an example. And so for here, if you were only making the minimum payment, it would take you about 40 months. That's like, what, 3.5 years to pay off the credit card. And you would end up paying about $634 in interest. If you made a little bit more, so your minimum is 20, if you made $25 payments, it would be 36 months and you would end up paying a little less in interest, $613, but that's still a long time. And so if you can afford to make more than the minimum payments, which I would say, unless you have some emergency where you've had to charge it up. Generally, if you're using it for day-to-day, you would want to make sure that you can do that, anything that you charge, it would be with the mindset that you can pay it off by the due date, so that you're, again, not incurring any interest and you're not carrying any balances on your credit card. If you are, again, everyone's situation is different. If you have to carry a balance on your card, again, I would highly, 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 highly recommend that you make more than the minimum payment that's due. Here I mentioned earlier, again, about the transactions. It'll list the transactions in detail. So should you have a discrepancy, or it really just gives you the ability to be able to go through and make sure that, again, the charges listed on your statement were conducted by you or an authorized user of your card. Earlier, I mentioned a little bit about the different annual percentage rates based on the type of transaction. And so here, in this scenario, the only thing they had was purchases, which were at 14.99% APR. And so then it gives me, based on the balance, and what the interest would be. If I had a balance transfer, it would be at 21.99%, and it would be listed here. Or if I did a cash advance, that would be listed down here in this table also. I mentioned earlier, making sure that we make our payments on time. So here it's double. So the penalty APR is actually 28.99% versus 14.99% for a just regular purchase. So if I pay my payment before on the due date, I'm going to be charged this 14.99%. If I don't, I'm going to be charged this 28.99% penalty APR. Now, if you make your payments on time consecutively for 6 months, then the creditor has to go through and reevaluate. And if they've done a review of your account and you've made those payments, again, either on or before the due date, to go through and lower the penalty APR on your account. So, but again, that's 6 months worth of on-time payments.
Standard for credit card companies to follow, a standard rule?
Yes, so that's actually mandated by federal law. And so again, if you don't make your payment on time and they start charging you that 28.99% on those purchases that you made, then after 6 months of consecutive on-time payments, then they're required to go through, reevaluate, and lower your, remove the penalty APR from your account.
Oh, that's good info. Thanks, Michael.
You're welcome. Let's see. So I know we kind of skipped ahead because of time. So I do want to see if there's any other questions, I guess, related to credit cards. While we're waiting, I would say, again, my personal opinion, again, they can be a very, very useful tool. It just depends on how you manage it. And if you are going to apply for a credit card, making sure that, again, it's a card that's going to work for you and that you understand totally and completely how it's going to work. without having or fully understanding it, it can lead to trouble. I could say it can lead to yeah, a lot of big trouble, and it has like a ripple effect. We all know that credit affects us in so many ways. In the past was mainly tied to, again, purchases or buying things on time on credit. Now it's extended to employment, car insurance, etc. And so making sure that any products or services that we're utilizing, that we fully understand, again, how those products and services may impact us, not only from a, I guess, direct financial standpoint, meaning dealing with our ability to get credit, but also, again, other areas that, again, we may not think about, like, again, banking or financial services industry if you're looking to apply for a job. So if you wanted to apply for a job with us, if you have less than perfect credit, you're going to be declined employment. You could be, again, very good at what you do, but because, again, that's one of our stipulations in our policy, they would decline you for employment. And I know there's a lot of institutions in the financial realm that does the same thing. So again, I would say,
good info. That's
sure that you,
I'm sure that perked up folks' ears when it relates to job, and when you're looking at another career and how credit plays a role in that. And you made some very good points there. Thank you, Michael. I appreciate your time this evening.
absolutely.
And do know we'll definitely share your contact information with the folks here. Once again, thank Michael for his time. And before we go, I want to let Marianne just share some upcoming workshops and some updates to our audience, and then we'll let our chair, Marianne, she'll close us out. But Marianne, you want to give everybody a few updates?
Yes. First, I want to thank everybody again for joining us this evening. We certainly appreciate it. And I also want to thank Mr. Daniel Garcia, who is the Vice President